Alright guys, welcome to this lesson on bearish engulfing. So let's get into the disclaimer for a while before we move on. So basically, what is a bearish engulfing pattern? Now basically it looks like this. It is a small green candle followed by a large red candle. And like I said, preferably the small green candle doesn't have really long shadows. It has to be small. So some people would call this pattern an outside bar or outside pattern. So it's opposite to that of Harmy pattern. Harmy pattern, some people call it the inside bar. Then engulfing pattern, some people call it the outside bar. You realize that the second body would engulf the first body, which presence of wicks are not that significant. So the key focus here is the body size. So when you see this pattern, there will be a potential reversal from bullish to bearish if you see this in an uptrend. And bearish engulfing has a higher probability of reversal as compared to bullish engulfing. Okay, so some of the things to take note. First thing first, price won't go from bullish to bearish immediately. So when you see a bearish engulfing pattern, sometimes you might see that the price would go sideways, consolidate a little bit before it goes down. But if the signal fails, then of course the signal will go up. It wouldn't go bearish, which is the direction you want. Then the second thing is reversals may be delayed. Like I said, you may see a little bit of consolidation before it goes down. Okay, so some of the factors you need to take note of when it comes to the strength of the signal. First thing first, when you see a large bearish candle that engulfs the small candle, then it's a strong signal. So if I'm to ask you, which one is the stronger signal, the first one or the second one? So the larger the difference between these two candlesticks, then the stronger it is. When you see a big bearish candle that forms right after a small green candle, this tells you that sellers are in strong control. So hence, the stronger the bearish signal is. So if I give you one example, so you see a small bullish candle followed by a big red candlestick, and the third candle that forms is a doji, and the fourth candle that forms is a bearish signal. So this confirms the reversal. And remember, you need a lot more confirmations to tell you that a reversal is forming. Don't just rely on candlestick signals alone, okay? So the second factor that is going to enhance the strength of this pattern is when you see a strong rally before the pattern. When there's a bullish trend that slowly progresses upwards, slowly, and then at the end of the trend you see a bearish engulfing pattern. This wouldn't be as strong as compared to a bullish trend whereby you see a massive spike, a bullish candle, okay, and then the next candle that forms is a bearish engulfing. So when you see a massive spike, especially a big bullish candle before this pattern, this increases the probability that the price is going to go down after the formation of the bearish engulfing. Okay, because what happens is that buyers have become exhausted. Then when the prices are so high, they will start taking profit, and hence the price will start going downwards. And another point for stock traders, if you're a stock trader, the higher the volume that you see when this candle is formed, then the higher probability there is for the price to continue to go down. Okay, but because we are mainly focused on currencies right now, we don't really need to observe the volume. Okay, so I give you one example. You can see a bullish trend over here. Okay, it's more of like a more volatile bullish trend because markets are going sideways a little bit, and at the end of the trend you can see a big spike. Okay, a big spike, and so there's a resistance level over here. Alright, and you see a false breakout, obviously, because the candlestick that forms after the false breakout indicates that the markets might reverse. Okay, so you see a small bullish candle over here followed by a big red bearish candle. Okay, and this is enough to reverse the bullish trend into a downtrend. So the third factor that is going to increase the strength of this pattern is the surrounding number of bars. You can see that there's a bearish engulfing pattern over here. Before this pattern is formed, it engulfs several different other candles. Do you see that? It not only engulfs one candle, but it engulfs 1, 2, 3, 4, 5, 6, 7, about 7 candles. So the more candle it engulfs, the higher probability that the price is going to reverse, because it tells you that the balance between buyers and sellers have shifted to sellers. When markets are going sideways for a while, it tells you that people are indecisive. And yes, you can see a couple of indecision over here with a couple of doji spinning tops. And when the big bearish candle happens, okay, this confirms that, okay, after this indecision is over, the sellers are the one who took control. So the big bearish candle is the confirmation, and hence the trend reversed from bullish to bearish. Okay, let me give you some case studies right now. First thing first, I drew a resistance line over here. Okay, and can you spot where is the bearish engulfing? Right here. Do you think this would become a strong reversal, or would this reversal be weak? Apply what you learned just now. Okay, first thing first, you see a big bullish candle over here. So remember when I said that when there's a big spike upwards, okay, this increased the chances of profit taking. Okay, when the price became overextended, especially when it hit a resistance line over here, then high chance it's going to bounce off. So basically, bearish engulfing, you use resistance line, and then bullish engulfing, you use support line, okay, support zone. So this is the first criteria that tells you that the chance of a reversal will be high. But of course, at this point in time, it hasn't touched the resistance line yet. So right after that, you see the bearish engulfing pattern form, but then it engulfs not only one candle, but it engulfs about 3 candlesticks. So the more candlestick it engulfs, the higher the chance of a reversal, and hence this is the second criteria that increases the chances of a reversal. Then of course the third criteria is the resistance line. Okay, so another example for you. There's a bullish trend right here, as you can see, and if you draw your resistance zone based on this point and this point, okay, roughly you have a resistance that goes like that. And your bearish engulfing pattern, it tests this resistance zone. Of course, this is not a super strong one because the bullish candle is pretty big. In fact, it exceeds more than half of the red candle's body. So this is not a super ideal bearish engulfing pattern, but yet with that, the third candle that's formed is a bearish candle, which confirms the reversal, and hence you see a reversal from a bullish to a bearish trend. Bearish engulfing pattern, it doesn't work all the time, just like any other signals. And also the other thing is that bearish engulfing pattern, it doesn't tell you to what extent it will reverse to. Okay, so for example, you see one over here. Instead of retracing by a lot, it only retraces a little bit before it bounces back up. Okay, and then just like any other pattern, bearish engulfing pattern would fail. For example, I show you a failed pattern, which is this one. A big red candle, and then before that there's a small green candle. But yet again, you see that this pattern is not too strong because the green candle is pretty big. So why did it fail? First thing first, you can see a couple of clues. The first clue is that the third candle that is formed, in any candlestick formation, you need confirmation, which is the third candle or the subsequent candle formation. So the third candle is formed, and then it's a green candle. So this gives you a signal that, okay, this signal might potentially fail. Okay, and when this candle forms, it opens and closes above the bearish engulfing pattern. This is a confirmed signal that the signal has failed, and also because this, as you can see over here, is a support level where the price bounces off. Okay, so when you see a bearish engulfing, especially in a support zone, be very careful. Just be very careful. Okay, so give you one more example of a good trade. First thing first, you see a bearish trend over here, so you're looking for a sell. So we want to look for a bearish engulfing pattern, which is over here. Can you see? Okay, why is this a good trade to get into? First thing first, it forms at a critical level. If you can see, it tests this moving average, this white line, which is a 100 SMA. Second thing is, the third candle that forms is a red candle. Can you see? So what you can do is that you can sell when this candle closes, enter here, put your stop slightly above the moving average, and you can put your TP target at the recent swing low. But since this tests a critical level, some aggressive traders might enter over here. Okay, enter sell here, and this way you get a good risk to reward ratio when you put your TP target at the recent swing low. Okay, in fact, this support level that you can see. And another thing that increases the chances of the price going down is look at where CCI is. CCI is overbought. Okay, so this increases chances that the price is going to bounce off from the moving average. Okay, and as you can see, it also bounced off this green trend line over here that I drew. But with that said, if you're a conservative trader, because you're entering a little bit later, so risk to reward ratio is not that good, so I wouldn't recommend you to go in. Okay, but if you're an aggressive trader, you might be able to enter at a better price. So I'll give you another example. This time I'm using stochastics. Now the reason why I'm switching between different momentum indicators is because, like I said, you choose just one. Because if you choose too many momentum indicators to put in your chart, you'll be confused. So you gotta pick one which you like, one which you're comfortable with. Okay, I'm going to help you pick which oscillator to use by comparing the three in the subsequent lessons, so don't worry about that. Now you can see that this downtrend. I drew a trend line over here, and where's your bearish engulfing? Over here. Can you see? This is not super strong because the red candle is quite small, but it's still considered a bearish engulfing pattern. So rub this off a little bit. Okay, so you can see that this bearish engulfing pattern engulfs not only one candle but several other different candles. So total engulfs about 4 candlesticks. So this kind of increases the chances that this signal is pretty strong. Second thing is that it tests your 100 SMA. Okay, so this is the second clue. Third clue, look at this trend line. It tests one time, second time, on the third time. When it comes to trend line, remember that it is better to enter on the third touch. Of course, some people, they cannot wait until third touch. They enter on the second touch, which is a little bit risky. So there's a third confirmation. There's a confluence between moving average and trend line. So the higher probability trades are always when it is at the confluence of different various indicators. Because it's like having a double layer ceiling. Instead of having one layer like moving average, you now have double layer ceilings, trend line and also moving average. And of course, the fact that this downtrend increases the probability that the price is going to go down. And then look at stochastics, it is at overbought. Okay, overbought. And the fast stochastics is starting to cross the slow stochastics. This gives you a clue that price might continue to go down. So if I'm to rub this off, wait for the third confirmation, which is this candle, and then you can enter at the close, enter a sell over here. Then you can put your stop slightly above the 100 SMA. Then you can put your TP target at the swing low. Okay, slightly above it, not right at the swing low. Understand what I'm saying? So even if you're a conservative trader, you can see that you're entering at a good risk to reward ratio. So if just now the trade you feel that the risk to reward is not good, then just wait for this kind of trades. Okay, wait for this kind of trades. And also to increase your probability, look at H4. Make sure that it is a bearish trend as well. You don't want to look at H4 and then be like going up trend, but then H1 is going down trend. You don't want these two time frames to conflict each other. Again, this will be talked more about in the lesson on multi-time frame analysis. The next example I'm going to show you is a trade where the risk to reward is not so good and you probably wouldn't want to enter into that. Okay, see almost the same thing, a bearish trend. Okay, trend line, test first time, second time, third time, bearish engulfing pattern over here. Alright, now it seems like this signal is pretty strong because stochastics also went to overbought and it went down to the neutral level. But remember your TP target, it should be at the swing low, recent swing low. So you can see a support level over here. Alright. If you're an aggressive trader, the earliest you enter is right somewhere right here. You enter here. Right? And then your stop would be slightly above the 50 SMA. Okay? Because you see it tests 50 SMA and then also tests trend line. Over here. Alright? Now I know some traders, they follow this rule of, okay, if my stop loss is 300 points for example, then I should set my TP target at 300 points, regardless of the market conditions. Now this kind of systematic trading approach is a bit too rigid, because what if your 300 points target, there is a strong support level over there? Then it might bounce off before even hit your TP target. So if you be like, okay, because this trade from here to my stop loss is example 300 points, let me just set it 300 points, same thing. Then the price might not even hit your TP target. Understand what I'm saying? So I prefer you not to follow it like that. You're gonna trade this system based on current market conditions. Look at where the swing low is, swing high is, any recent support levels you need to take note of, and is the risk to reward ratio ideal based on the current market conditions. So I wouldn't enter into this trade as compared to this one. This one is a good trade, whereas for this one I probably wouldn't enter, because you know there are better trades out there like this one. Alright. Okay, the next example, I'm gonna use RSI because, like I said, people would use different momentum indicators. So I'm just going to apply all into different examples. Again, you see a downtrend over here. Alright, so you realize that by now, you'll enter a trade using bearish engulfing when it is in a downtrend, right? Because if you enter into a bearish engulfing pattern in an uptrend, you are trading against the trend, which is a bit risky. Again, a trend line here, test 1 time, 2 times, 3 times. Okay, can you see where bearish engulfing is? Over here. It engulfs couple of candles, 1, 2, 3, 4, 5, 6, 7. So you can see that this is pretty strong. Okay, it tests your trend line, and at the same time it tests your 100 SMA. I don't know where you can see over here, the white line. Okay, it tests your 100 SMA, which is your white line. So there's a confluence again, which increases the probability of the trade. Now the thing is, RSI, it won't give you as many signals as compared to CCI and the stochastics. This is just how RSI is. So if you change this RSI to CCI, it will give you an overbought signal. But if you are using RSI, you see a slightly almost reaching overbought. So what you can do is that you can enter the trade here. Once this bearish engulfing pattern close, enter here. Alright, then you can put your TP at the recent swing low, which is somewhere here. TP target. Okay. And then you can put your stop slightly above the 200 SMA. Okay, which is also slightly above the bearish engulfing pattern. So this is trading based on market context. You realize that by now this is not a systematic trading system where everything is fixed and rigid. Okay, stop loss must be this amount all the time. TP target must be this amount all the time. This is more of a discretionary trading system where we trade based on current market conditions. Okay, where we need to adjust, be more flexible a bit. If you feel that H1 time frame is not for you, you can apply this onto H4 time frame. Okay, in that case, you get a lot more pips. But the thing is, you need to hold your trade longer, so you need to know which time frame is suitable for you. Just that I look at H1 a lot, so that's why I give you H1 examples more. Alright, so with that, I hope that this lesson gives you a clear idea on bearish engulfing. So with that, I'll talk to you in the next lesson. Bye.